Hello everyone, hope you all are doing well. In our today's lecture, in our today's discussion, we are going to solve part B and part C of question number 3 of SBR exam of March and June 2024 attempt. Basically part C is linked with part B, therefore we are going to cover both of these parts in a single lecture. And these two parts largely pertains to the accounting standard IFRS 5, that is non-current asset held for sale. But obviously some of the portion of this part also pertains to IAS 10, that is event after the reporting period, and IAS 12 income taxes. So part B is of 8 marks and part C is of 8 marks. So let's just read the question. It says that Jobon company is the parent company of clothing retail group and the financial year end is 31st December 2007. So we have a company named Jobon company who is a parent company of a group, and the group is engaged in clothing retail business. The year end of the company is 31st December 2007. Then Exhibit 2 provides information about the sale of subsidiary that describes the plan to sell a wholly owned subsidiary. The requirement part B of this question requires us that using Exhibit 2 only, discuss whether title company should have been classified as disposal group held for sale and its result presented as arising from discontinued operation in the consolidated financial statement for both the years ended 31st December 2006 and 31st December 2007. So basically, as we know that the name of the parent company is Jobon company, who is a parent company, and there might be some subsidiary named title company, of which information is provided in Exhibit 2. And using Exhibit 2, we have to discuss that whether this subsidiary should be classified as held for sale, whether its financial performance for the year should be presented as discontinued operation in the consolidated financial statements for the year 31st December 2006 as well as 31st December 2007. And the weightage of this part is of 8 marks. So let's read the Exhibit 2 of this question. Exhibit 2 says, in the consolidated financial statement for the year ended 31st December 2006 and 31st December 2007, Jobon company classified a wholly owned subsidiary, that is title company, as disposal group held for sale. Title company results were also presented as arising from discontinued operation in the consolidated statement of profit and loss for both years. Title company is geographically distinct component of the Jobon group. So in the first para, this is basically stating some facts about the company, that the parent company Jobon company in its consolidated financial statements for the year 2006 and 2007 has classified the wholly owned subsidiary title company as disposal group, and its financial results for the year, financial performance for the year is presented as discontinued operation. This subsidiary is geographically distinct component of the group of the Jobon group. Alright. In the jurisdiction, sale of shareholding in subsidiary require authorization from the shareholders of the parent company. On 1st May 2006, the shareholders of the Jobon company authorized management to sell all the shares in title company within the next 12 months. But thereafter, the management would have to ask for further approval to sell the shares. At the same time, Jobon company instructed its agent to sell the shares as soon as possible at the current market price, and the shares has not been sold by 31st December 2006. So basically, in the jurisdiction of the parent company would need approval of the shareholders, would need authorization of the shareholders before selling the shares in a subsidiary company. And on 1st May 2006, shareholders authorized them to sell all the shares in the title company, but within the next 12 months. And if those shares are not sold within next 12 months, they have to take further approval from the shareholders. So after obtaining the shareholder approval, the company instructed its agent to sell the shares as soon as possible, and they are expecting just the current market price. But still by 31st December 2006, by the first year end, these shares has not been sold. These shares had not been sold. Then in the third para, in February 2006, in second year in next year, in February 2007, Jobon company relocated online sales division of another subsidiary to title company. As a result, title company recruited additional employees and purchased new computer equipments. Now in subsequent year in 2007, in the month of February, parent company allocated their online sales division from another subsidiary to this subsidiary title company. And as a result of increase in operations or increase in business, title company has to recruit some additional employees and has to purchase some additional assets. At the shareholder meeting in May 2007, there was no discussion on or further approval for the sale of title company. The updated instructions given to the agent by the director on 1st May 2007 stated that they were authorized to sell the shares in title company if cumulative losses suffered by title company for the year ended 31st December 2007 exceeds 20 million. And title company made quarterly losses of approximately 4.5 million per quarter during 2007. Okay. The first meeting of the shareholders was on 1st May 2006, in which the shareholder authorized approval for the sale of shares in the next 12 months. Then after 1 year, shareholders again met in May 2007, but in that meeting there was no discussion, there was no further approval for the sale of shares, of subsidiary company. But the directors instructed the agent that they were authorized to sell the shares of the subsidiary if the cumulative losses of the subsidiary for the year 31st December 2007 exceeds 20 million. And actually, the subsidiary made quarterly loss of 4.5 million per quarter. So if a year has 4 quarters, it's mean the total actual loss would be 4.5 multiplied by 4, and this is equal to $18 million. So in 2007, from the information, there is some transfer of operations, there is some transfer of some online sales division to the subsidiary. Subsidiary recruited new employees, purchased new assets. There was no further approval from the shareholders, and the sale of shares of the subsidiary is subject to condition that the losses of subsidiary exceeds 20 million. But the losses are actually 18 million, that is 4.5 million per quarter into 4 is equals to $18 million. Alright, so this is the facts that were provided in the question. And what was the requirement? The requirement is to discuss whether title company should be classified as disposal group and whether its results should be presented as discontinued operation in 2006 and 2007. So, as we all know that first of all, as per IFRS 5, non-current asset held for sale and discontinued operation. If we recap the definition of discontinued operation is a component of entity that is either classified as held for sale or is actually disposed of. Discontinued operation is basically the component of the entity that is either classified as held for sale or actually disposed of, and that represents the major line of business or geographical area of operation, or it is a part of a strategic plan to dispose of the major line of business or geographical area of operation, or it is a subsidiary that is acquired exclusively with a view to resale. So in this question, it is clearly given, it is clearly mentioned that title company is geographically distinct component. So apparently title company meets the definition of discontinued operation. But now for the classification of asset or disposal group as held for sale, there are some criteria, there are some 5 to 6 conditions under IFRS 5 that need to be made for such classification. And those conditions are that the management is committed to plan to sell the asset is available for immediate sale, their sale is highly probable, that is within next 12 months, active program to locate the buyers are started, the asset is marketed at a reasonable price relative compared to its fair value, and there is no possibility or there is no indication that the plan to sell the asset will be ultimately changed or withdrawn. So if we evaluate all this information, we can conclude that by 2006, even on 1st April 2006, the classification criteria of IFRS 5 is met. First, the shareholder approval was obtained for the sale of shares. Second, agent was instructed to sell the shares. Third, the shares are to be sold at current market price. So from this information, it appears that the IFRS 5 classification criteria was met on 1st May 2006, and based on this, we can conclude that its classification in 2006 as held for sale, as discontinued operation is correct. Its presentation and disclosures are correct. But still the shares are not sold by 31st December 2006. Now what do IFRS 5 says in this regard? IFRS 5 says that practically yes, this can happen, that once you classify an asset or disposal group as held for sale, meaning thereby that the sale is highly probable within the next 12 months, but that sale might not actually materialize or might not actually execute it because of the reasons, because of the circumstances that are beyond the company's control, that were not initially estimated or initially forecasted when we were classifying the asset. So even after the period of 12 months, the asset or the disposal group is still not sold, we can still classify that asset or we can still classify that disposal group as a held for sale, subject to the same conditions that all the classification criteria are met. But when we look the facts that happened in 2007, that the company has transferred an online sales division to the title company. The title company has recruited some additional employees. They have purchased some new assets. So these are sort of a indication that now this subsidiary is not available for its immediate sale. Available for immediate sale in its existing condition. Still, no further discussion or approval from the shareholders was there. Even the agent was instructed to sell the shares, subject to the condition that the cumulative losses exceeds 20 million. But in reality, the actual loss was just 18 million. So based on this information, one can easily conclude that in 2007, after the lapse of 1 year period, now the classification criteria under IFRS 5 for classification as held for sale is no more met. So in 2007, this subsidiary, this geographically distinct component should not be classified as held for sale, would not be presented as a discontinued operation. And in 2007 financial statements, its assets, liabilities, income, expenses, results should not be classified as a held for sale, should not be classified as a discontinued operation. So its classification should be changed in 2007 as well as in comparative year 2006. In 2007, the IFRS 5 classification criteria is not met. So we would again classify this subsidiary as a part of continued operation, as a part of our normal business, and we need to restate the comparative figures for 2006 as well. So let's read what the answer is provided by the ACCA examiner. It says, in accordance with first it's talking about the year ended 31st December 2006, and then it's talking about for the year ended 31st December 2007. In accordance with IFRS 5 non-current asset held for sale and discontinued operations, the following conditions must be met for an asset or disposal group to be classified as held for sale. The management is committed to plan to sell. The asset is available for immediate sale. The active program to locate the buyer is initiated. The sale is highly probable, that is within 12 months of the classification as held for sale, subject to limited exception. And what are those exceptions? We are going to discuss those in next year. Then the asset is actively marketed for sale at a sales price reasonable in relation to its fair value. The action required to complete the plan indicate that it is unlikely that the plan will be significantly changed or withdrawn. So basically in the first para, they are just jotting down the classification criteria for held for sale or discontinued operation. Then the presentation of investment in subsidiary title company as disposal group held for sale would seem to apply for the year ended 31st December 2006. This is because shareholder of the Jobon company, that is parent company, authorizes management on 1st May 2006 to sell all the shares in the title company within the next 12 months. At the same time, parent company, that is Jobon company, has instructed its agent to sell the shares as soon as possible at current market price. And the actions of the Jobon company at this stage seem to also indicate that it is unlikely that the plan will be changed. The shareholder approval is required in the jurisdiction and therefore should be considered as a part of assessment of whether the sale is highly probable or not. So based on the facts given in the scenario, we can conclude that the classification, that the presentation as held for sale seems to apply, the presentation is appropriate. In accordance with IFRS 5, a discontinued operation is a component of entity which has been disposed of or is classified as held for sale and which represents the separate line of business or geographical area, is a part of coordinated plan to dispose of the above, means geographical area of separate line of business, or is a subsidiary acquired exclusively with a view to resale. Title company is distinct geographical component which meets the criteria to be classified as held for sale. Therefore, its results were correctly presented as arising from discontinued operation in the year ended 31st December 2006. So they have reproduced the definition of discontinued operation under IFRS 5, and based on the classification criteria, based on the definition of discontinued operation, based on the facts given in the question, the results are correctly presented as discontinued operation for the year 31st December 2006. Now, moving forward to next year, for the year ended 31st December 2007, a disposal group can exceptionally be classified as held for sale or discontinued even after the period of 12 months if it still meets certain criteria. These criteria refers to occurrence of circumstances arising which were previously considered unlikely. As a result, the non-current asset or disposal group previously classified as held for sale is not sold by the end of that period. However, the sale still has to meet the classification criteria to be classified as held for sale even after the 12-month period has elapsed. Look, one of the conditions for classification as held for sale is that the sale is highly probable within the next 12 months of classification. But in exceptional circumstances, those circumstances which were considered unlikely at the time of classification, this might happen that the asset or group is not actually sold within 12 months. Still, that asset or disposal group can be classified as held for sale subject to the condition that the criteria for held for sale are still met. There is no real evidence that title company met the held for sale criteria for classification as disposal group over the extended period beyond 12 months. The instruction to the agent now stated that they were authorized to sell the shares in the company if losses suffered by the title company exceeds 20 million. Whereas title company quarterly losses of approximately 4.5 million per quarter during 2007, which cumulatively did not reach the threshold of 20 million. First, it's talking about that the agent was instructed to sell the shares if the cumulative losses exceeds $20 million. But actually the subsidiary has quarterly loss of 4.5 million, so the yearly loss is 18 million only. So this condition is not met. Then, in addition, Jobon company transferred additional activities to title company, that is their online sales, during February 2007, meaning that title company recruited new employees and invested in new asset. This fact further confirmed that title company was not available for sale in its present condition. Again, this is talking about this para, that since the parent company has transferred the online sale division to the subsidiary title has recruited new employees, purchased new assets. So these are indicators, or these take us to the fact that the subsidiary is not available for immediate sale. Also, at the shareholding meeting in May 2007, There were no further discussion on or approval for the sale of title company. The authorization to sell the shares in title was only granted for 1 year in May 2006, and this was not authorized again by the subsequent shareholder meeting in May 2007. And shareholder approval is required in the jurisdiction in order to sell the shareholding in subsidiaries. So in the second meeting in May 2007, there was no further discussion, there was no approval taken from the shareholder to sell the subsidiary shares. Based on all the above analysis, investment in title company should not have been shown as disposal group in the consolidated financial statement at 31st December 2007. As such, its results should not have been presented as discontinued for the year ended 31st December 2007 either. The classification of title company as held for sale in comparatives for the year ended 31st December 2006 and the presentation of its results would need to be restated. So in 2007, the classification criteria are no more met. So this subsidiary would not be classified as held for sale. Its results would not be presented as discontinued operation in their financial statements for the year 2007. And obviously in 2007 financial statements, the comparatives for 2006 would also be restated. So this was part B of this question. Now let's move forward to part C. The part C is of 8 marks too. It says that using Exhibit 3, what is Exhibit 3? Exhibit 3 provides information about after date events. Describe event after the reporting period which may impact accounting treatment and the presentation of wholly owned subsidiary. So there might be some events after the year end that might change our presentation, that might change our answer. The part C requires us that using Exhibit 3 explain whether the receipt of signed letter on 1st April 2008 affects your answer to part B. So there might be some information about some signed letter in Exhibit 3, and based on that letter we have to conclude that whether our answer under part B would remain the same or it would change. And then it also requires us to explain whether the deferred tax asset should be recognized in the financial statement for the year ended 31st December 2007 or the year ended 31st December 2008. And we need to explain about something about the deferred tax asset. So let's read the Exhibit 3. Exhibit 3 says on 1st April 2008. So now we are in a post year end event. We have the year end for the 31st December 2007 has passed, and now we are on 1st April 2008. On 1st April 2008, after the publication of preliminary results of the group, but before the authorization of consolidated financial statements for issue, Jobon company received a signed letter from a third party outlining its intention to purchase title company. The transaction price was far below the original price paid by Jobon company due to the significant losses of title companies since the year end. So basically, after the year ended 31st December 2007, on 1st April 2008, when the preliminary results of the groups are published, but still the consolidated financial statements are not authorized for issue. Now parent company received a signed letter from a third party showing its intention to purchase the subsidiary title. The transaction price was far below the original purchase price which Jobon company paid, but this is due to the fact that subsidiary had suffered significant losses. The sale was agreed to complete on 1st January 2009. At 1st April 2008, shareholder also approved this sale. The agreed sale of title company will create a tax allowable loss which can be carried forward to reduce future taxable profits. Jobon company has recognized a deferred tax asset in respect of this issue in its financial statement for the year ended 31st December 2007. The deferred tax asset was calculated by taking the value of title company for tax purpose of 12 million multiplied by the corporate tax rate of 30%. The tax loss was acceptable under local legislation, and Jobon company expected to be able to set off the taxable loss against its future taxable profit. So based on the post year-end event of 1st April, they have recorded a deferred tax asset because they anticipate that this sale will create a taxable loss, and that taxable loss can be adjusted against future taxable profit, which is also allowed by the local laws, local legislation. So they have created a deferred tax asset at the rate of 30% on the tax value, on the tax base of the subsidiary of $12 million, because they anticipate that they would be having future taxable profit against which they can adjust these losses. All right, this is exhibit 3. Now again, what was the requirement? So the first part of the requirement is to explain that whether the receipt of signed letter on 1st April affects your answer to part B. Look, we have also studied IAS 10, the title of which is event after the reporting period, And as per IAS 10, event after the reporting period means those events, they might be favorable, they might be unfavorable, that arises after the year end, but before authorization. Now in this case, we have received a signed letter of intent on 1st April 2008, and on 1st April 2008 the preliminary results of the groups were published, but still the financial statements are not authorized for issue. It's mean that this event falls within the umbrella of IAS 10. Yes, it is an event that needs to be considered as per IAS 10, event after the reporting period. Now IAS 10 classifies those events into two categories. One is adjusting event, and the second is non-adjusting event. IAS 10 defines both of these. Adjusting event are those events that arises after the year end but provide condition that existing at the year end, and we need to adjust those events in our financial statements for the year. Whereas non-adjusting event are those events that are indicative of the condition that arise after the year end. So based on this, we have received the letter of intent on 1st April. We have received the shareholder approval on 1st April. So we can easily conclude that the IFRS 5 classification criteria are again met, but on 1st April. So as per IAS 10, it is a non-adjusting event. And since it is a non-adjusting event, we don't need to adjust our 2000X financial statements. Yes, that this event can be material and we can disclose this event, but we would not adjust our financial statements because of this 1st April 2008 letter of intent, because it happens after the year end and it is sort of a non-adjusting event because nothing was there when the financial statements were closed, when the year ended 31st December 2007 was closed. So yes, the classification criteria is again met, but not on 31st December 2007. It was met on 1st April. So this is a non-adjusting event, and we don't change our argument, we don't change our conclusion that was in part B based on this information. Our conclusion would remain the same, that this subsidiary would not be classified as held for sale, as discontinued operation in the financial statement for the year ended 31st December 2007. In the second para, they are talking about something deferred tax asset. Now we all know that as per IAS 12, deferred tax asset is recognized for all temporary deductible differences, for tax losses, for tax credits, when it is probable that there would be taxable profits available in the future, and we can adjust our losses, we can adjust our deductible differences against the taxable profits and save the taxes. And it is also allowed under the local law. But again, this loss is linked to the classification criteria of IFRS 5. If the classification criteria would have been met, then deferred tax loss, deferred tax asset would have been rightly recognized in 2007. But since we have already concluded that the classification criteria is met on 1st April 2008, not on 31st December 2007. So deferred tax asset should also not be recognized in 2007. In 2007, we would not classify this subsidiary as held for sale based on this information. And in 2007, we would not record any deferred tax asset, because deferred tax asset is based on this sale, and this sale happened on 1st April 2008. Yes, since on 1st April the classification criteria is again met, the subsidiary would be classified as held for sale in 2008 financials. So recognition of deferred tax asset in 2008 is appropriate, but that deferred tax asset cannot be recognized in 2007. So let's read the ACCA suggested answer. It says, for signed letter of intent to purchase, in accordance with IAS 10, event after the reporting period. An event after the reporting period is one which could be both favorable or unfavorable, and which occur between the end of the reporting period and the date when the financial statements are authorized for issue. An adjusting event is one which provides evidence of condition which existed at the end of reporting period, whereas non-adjusting event is one which is indicative of a condition which arose after the end of the reporting period. So in the first para, they are explaining about what is IAS 10, on which event IAS 10 apply, what are adjusting event, what are non-adjusting event. Then, although the preliminary result of the group had been published on 1st April 2008, the financial statements had not yet been authorized for issue. Therefore, the letter of intent, the signing of letter of intent should be taken into account before the authorization of financial statement. The sale of title company is now highly probable. However, the issue arises whether the signing of the letter of intent constitutes an adjusting event or non-adjusting event. As the held for sale criteria were met on 1st April 2008, the condition did not exist at the end of the reporting period. This means that investment in title company should still not be shown as a disposal group held for sale, and its results presented as arising from discontinued operation in the consolidated financial statement for the year ended 31st December 2007. So in the first para, they explain what IAS 10 is, what are adjusting event, what are not adjusting event, and then in the second para, they conclude that this letter is to be evaluated under IAS 10. But since the criteria was met on 1st April 2008, whose condition does not exist at year end, so it is a non-adjusting event, and we don't need to adjust our financial statements for the year 2007. Then for the deferred tax asset, it says that in accordance with IAS 12, an entity should recognize a deferred tax asset for all deductible temporary differences arising from investment in subsidiaries to the extent that, and it is probable that, temporary differences will reverse in the foreseeable future and taxable profit will be available against which temporary differences can be utilized. So again, in the first para, they are just explaining what IAS 12 is and when we record the deferred tax asset. Jobon company treatment of deferred tax asset does not conflict with the requirement of IAS 12. This is because the sale of title company is highly probable, and tax allowable loss can be used to relieve the future taxable profit. However, deferred tax asset should be recognized when the held for sale condition of IFRS 5 are met, and this did not occur until 1st April 2008. Therefore, deferred tax asset of 3.6 million. This 3.6 million is basically tax base of 12 million multiplied by 30%. and therefore deferred tax asset of 3.6 million will be recognized in the financial statement for the year ended 31st December 2008, not in 2007. No adjustment is required in the consolidated financial statement for the year ended 31st December 2007. So in the first para, it is explained what IAS 12 is and when we record deferred tax asset. In the second para, the approach of the company to record deferred tax asset is in line with IAS 12, is in line with the local legislation, local regulations. But this is based on the classification criteria and which is met on 1st April. So we can record deferred tax asset in 2008 but not in 2007. So these are the part B and part C of this question, and I hope I would have been able to explain these both parts clearly to you. Thank you for watching and see you in the next lecture.